I get a lot of questions about how do I find a bank to partner with, especially on smaller deals, sub $2 million deals. And I figured with the economic uncertainty we are facing, especially in a climate of rising interest rates, I bring on a good friend of mine that I've known for many, many years. I've done many, many loans with of Truist. Ladies and gentlemen, meet Steven Gunzehnauser. Yes, that last name is real. Everybody calls him Guns. A plus, 10 out of 10 for last names. Steven, welcome.
Hello, thank you for having me. The long German last name certainly makes for a cool nickname. But glad to be here. Thanks for having me, and looking forward to chatting today.
Briefly catch us up to speed, those who don't know you. How long have you been with Truist? What's your backstory? How long have you been doing commercial lending?
Yeah, so I've been with Truist. This is my 15th year. I was on the BB&T side of things, so only bank I've worked for, which is unique in the banking industry. And started kind of from the bottom as a credit analyst into a portfolio manager, basically on the credit side of things. Did that for about 8 years, and about 5, 6 years ago, moved into commercial real estate. Just thought it spoke more to me, understood it better. And the last 5 years have been a commercial real estate lender or a relationship manager, working with developers and investors here in the Charlotte, Metro Atlanta region, and then the western part of the state, including Asheville. So I look at a variety of deals. I'm a generalist, so hospitality, multifamily, retail, industrial, self-storage, and mobile home parks, along with some single-family builder finance as well.
What's always caught me interesting is you said a good chunk of your business is hotels.
It was pre-pandemic, probably a good chunk, maybe half my portfolio was hotels. It's a tight knit community, much like mobile home parks, and the market was really strong. So the last 2 years, 20 and 21, have been challenged with that, but actually, certain markets are really rebounded, especially in the leisure markets, coastal, and especially somewhere like Asheville. So hotels are coming back. It's just kind of location specific.
So let's talk market outlook. Obviously, the Fed is raising rates arguably very aggressively. You can say all you want about how this should have been done a long time ago, but where does it go from here?
We had the last couple of years just unprecedentedly low interest rates, and I'm talking, floating rates under 3%, fixed rates 3 to 3.5%, and that changed in a matter of 6 to 8 months. I mean, at this point, I'm looking at swaps that are over 6%, like an interest rate swap. Many banks aren't even offering fixed rates anymore, or if they are, maybe, between when the term sheet's offered and when it actually closes, the Fed could move rates, and suddenly that fixed rate is below prime. I mean, prime's what, 4.75 right now, went up 75 basis points, which was a rapid change from what was expected. Another 50 in July, I think. And then, I mean, they're looking at another 1 to 2%. So thankfully, from what I've seen with my clients, things have changed so fast that there's not an expectation of rates being 3 or 3.5 or even 4% right now. And it's just a change in how you kind of build out, the assets that you're looking at. But the cost of capital is going up, and we're seeing a lot of just floating rates in the interim as opposed to fixed rates. So at least at Truist, at least what I do, we don't really offer bank held fixed rates. If someone wants a fixed rate, we do it via an interest rate swap through our capital markets group.
Important to note, this is being recorded on June 30th of 2022. So, things will change. We don't know if it's going up, down, or sideways, or backwards, or who knows. But that's interesting to hear. From a transaction volume standpoint, have you already gotten less loan requests, less refinance requests? What have you already started to see in reasonably short order?
For the 75 basis point hike, I saw an increase because I think a lot of companies and firms wanted to try and get in before things went wild. I'm seeing around the same kind of volume, but people are just having to be more creative with the way that they're structuring their deals.
Hmm.
At the same time, depending on the development, lumber's come down. It was $1,400 per thousand board feet as of March, and I think it's down to $650 per thousand board feet. Now, that's not an automatic, immediate thing, but there's more lumber now, right? I mean, home prices are going up. There's smarter construction as opposed to just everyone building a bunch of specs, and there's still a need, at least in the Charlotte metro market. I mean, other markets may be overbuilt, but in Charlotte, there's an affordable housing crisis in general, and that stretches from, mobile home parks to Class B and C multifamily to even homes. I mean, I can go off on a tangent on this, but I feel like the rise of multifamily in Charlotte is a function of the increased home prices, where there's really no longer in close proximity to Charlotte where people want to be, because many younger people are location driven first. And with, the great, not the recession, but the great resignation, people are choosing their lives a lot more, especially where they live. So with home prices, there's really no starter home anymore at 300,000 that's close in. Those homes are 550, 650. And so you see people staying in multifamily for maybe 3 to 7 years longer in order to save up for that down payment. And so there's no, 3 to 5 year starter home. They're buying later, mid to late 30s, in more expensive homes and then just staying there. So I think there's a lot less movement, but I think that's what's driven the multifamily market to continue to just grow, which is why you see so much multifamily here in Charlotte.
Charlotte is definitely not normal across the entire country. It's to your point. There was the Charlotte Observer said we're something like 20 or 25,000 affordable housing units light today. And it will take decades to build that out. And not only that, Charlotte really struggles with, relatively speaking, public transport. The light rail is great. I remember as a kid in high school when that vote happened and a nice chunk of people said, heck no, don't do this. And the light rail has done nothing but boom places like South End, which in retrospect, everyone's like, well, duh, of course we should have done that. It's like, hey, you didn't vote that way in the late 90s, buddy. And,
Right.
Now they're talking about going out to the airport and going up as far as, Davidson area and taking it out to Valentine. But it's like, man, the amount of easements you'll have to get and eminent domains you'll have to do and the deals you have to cut to traverse through an already complicated topography to begin with, it's just tough, right? And so when you don't have, and the buses here in Charlotte are not a little scary to get on. It's not like New York City, right, where you hop on a bus and you're like, oh, whatever, that's normal. Like here you hop on the
New
bus
York,
and you're like, oh, is it
Chicago, Seattle, they all have great, bus systems. I mean, Charlotte is what, a fringe top 15 city in terms of population. I think Charlotte, if we're top 15, we're the only one that does not have public transportation, like a rail line from the airport to the city center.
Yeah.
And so, like you said, while it's needed, those easements and unfortunately eminent domain and whatnot, it's needed. I mean, the Charlotte airport is one of the main reasons why it's growing so quickly. I mean, shoot, we have 72 flights a day from Charlotte to New York, which is the main reason why we have so many transplants coming down here. And
Yeah.
what's the number? 60 to 100 per day of people coming down here. When the light rail was identified as expanding down Wilkinson, the real estate values in the next 3 months shot up, and everyone is buying it because they see what happened in South End. They see what's going on in Noda in the north part.
Yep.
And it's a 10 to 15 year blueprint of, okay, home values are going to go up. Now, going back to affordable housing, the homes along Wilkinson historically been more affordable than other parts, right? I mean, it's been Charlotte's kind of a have and have not city in terms of location, right? And the other side of 77 has been slower to develop, but it's coming in the next couple of years.
Yeah, public transportation is a huge part of whether or not you can live close to city center or not. Because if you don't have a good, reliable way of getting there, it just makes things difficult. I lived in Rock Hill for about 5 years, which on paper is great. It was 26 minutes from my house to smack dab city center, Charlotte, with zero traffic, which my folks who live in South Park, which is way closer, it takes the same amount of time because you hit red light after red light after red light. And when
Mhm.
you look at that, you're like, man, of course I'm going to live all the way out on Rock Hill, unless you run into the issue of I can't afford a new car or an older car with a ton of maintenance. And with gas prices seemingly never going to come back down again, you need to rely on public transport. And we just, in Charlotte, it's not great. So, what does that mean for us and mobile home parks and affordable housing in general? It just means in a place like Charlotte, and Charlotte's not alone in this regard. Asheville is another great, for example. You mentioned that earlier. I'm seeing this all across the Southeast and across the country in general. It's just not a lot of places you can live for a couple $100 a month and get a yard and not share a wall with a neighbor. That being said, banks still don't love lending on them. Steven, why?
um, well, I can only speak to Truist, and obviously anything I say is kind of my opinion and based off my experience. I don't necessarily want to speak for Truist as that general disclaimer. But at the end of the day, it's generally pretty simple. Mobile home parks are just not, quote, sexy assets. They're just not. Yeah, when you, it just, I really have no other way to put it because I've not seen, now granted, I work with you and a couple other, groups. For good operators, they are cash cows and they can be very profitable. But unfortunately, the perception by people in credit sometimes is, the one of old, right? Rundown properties, tires, trash everywhere, and fair or not, that's just the idea of what mobile home parks are. Because it has been an industry really until the last 5 years that was run primarily by mom and pops that got the properties for very cheap and were running it maybe not to maximize profits. So at least at Truist, we focus on strong operators that have experience, and that's really the number one thing that will allow us to mitigate some of the risks of each individual property and do some financing. There are things that we do like to see with certain properties. One is lighting on the property. Two is curbing on the road. And three is homes that are generally within 10 to 15 years old. Now, you and I have looked at some properties in the past where there's
That
been
does not apply.
all,
Correct.
well, we've not hit all three yet, but
Right.
we've looked at ones that have hit 2 out of 3 and then 1 out of 3. And I think what really helps is your track record and anyone's track record of taking properties that are challenged or maybe just haven't had the attention that they need and then turning them around. Nothing speaks higher than experience and paying loans on time and doing what you say you're going to do. And so for that, we still underwrite pretty conservatively, and there are things that we have to put into the loans and the way that we structure it that gives the bank some comfort in case it goes bad. Because a lot of our credit group is not necessarily incented to do a deal. So I have to structure it so that they can rest their head at night in case a regulator comes and checks on them and says, why did you do this loan? And if it's structured correctly, we have the appropriate collateral, we have strong sponsors with experience, and they've done it in the past, that allows us to get over the hurdle of maybe not having curbing. Maybe the homes are from the 80s and 70s. So those are some of the things that we look for. Some banks, though, I'll say this, the appetite changes every quarter for pretty much every bank. And I think that's the challenge for a lot of people getting into the business and talking to other banks and bankers. You have no idea whether we're full on mobile home parks or whether another
Right.
local bank has an appetite for it. And it changes. And I find out maybe once a quarter. Sometimes I find out when I send the deal up and they say, oh, yes, Steven, we're actually full on mobile home parks right now. We had a big deal in Florida and that's filled our bucket up. Well, I don't know that until I bring the deal up. So it ebbs and flows. And part of what my responsibility is to talk and communicate to my clients and let them know, hey, we're not turning the spigot off completely. but we need to reel back and maybe focus on some higher quality properties for this time. I know you've worked with a number of banks. It's on and off, right? I mean, you kind of get while the getting is good, and
Yes.
maybe you fill up, and then you work some debt down. You maybe take it to the permanent market. So there's a lot of other options as well.
Yeah, look, I would love to do a one-stop shop with one bank and just have that bank follow me everywhere I go. But to your point, there's different buckets of where you guys want to place your loans. And as soon as that bucket's full, or as soon as you get word from the top that it needs to change, or as soon as a new regulation comes out, need to do more of this or less of that, or this, that, and the other thing, that is largely out of your control. We're going to talk more in depth about credit in a minute in the credit department. Real quick, I wanted to touch on. Look, I think from just a because this everything you've said there is every bank says the same thing. Hey, it's just not sexy. But from as a mobile home park investment, but from a lender standpoint, I kind of get it. I kind of get it. And I want to hear your opinion on this. Look, in theory, I don't own any of the homes. And I'm basically just a cash flowing business that happens to own dirt. And in theory, someone could stick up their middle finger and move their home out, and then I can't find someone to replace it. And there's a limited number of buildings. There's a limited number of area and density for zoning. And a lot of these mobile home parks have really tough topography. So
Hmm.
their redevelopment options aren't necessarily great. Um, Tell me what any of that, does any of that play into kind of what credit's looking at, or for your competition and for Truist and just any credit department anywhere, are they really, is the biggest hang up really just like, do we really want to own mobile home parks on our books?
You'd be surprised those issues of so in terms of the property itself, there are concerns about environmental issues sometimes.
Hmm.
Maybe people are, you know, pouring oil on the ground or doing things that maybe they wouldn't do, on their own property if they owned it. Maybe they're, leaving trash or, there are always environmental issues that are a concern. In terms of those other things, not really. I mean, it's really, we focus on cash flow at the end of the day. Now, land itself is just inherently risky. You happen to have with mobile home parks land that you're just renting, and it typically comes with a home. So um, I've not run into those issues. It's more just there are many risks that the bank focuses on. One of those is reputation risk. And it's really just as simple as if there was a sign that said Truist financed this park and it's just a total mess of a park and an eyesore, the bank just doesn't necessarily want their name affixed to it. So we try and finance higher quality assets. And I think every bank, will do some loans that maybe are a little on the edge and then want to grow and do higher quality loans as the organization grows. Um, it's really that. It's not really no concerns about the topography or the other use. I've actually heard of some people buying mobile home parks, and since they're basically already have the taps, converting them into single family homes down the
Hmm.
road. So
I've
it's
seen that too. They
yeah,
parcel them to basically make it a subdivision. Tell
yeah,
me, I
exactly.
think it's a good transition now into I can feel it. I can feel it. Folks listening in are going, "Ah, you mentioned experience. I don't have any. I'm new to this space." What can some of the listeners who are greener do, say, put together a business plan, maybe a better pro forma? What can they do if they're bringing a deal to someone like you and they're very, very green?
When I put a package together and I take it to credit, I'm telling two stories. One is the quantitative story. Does the project make sense? Does it cash flow? Do you need to put capex in? What does that look like? What's the timeline for it? And basically, are you buying it at the right price? And do you have reasonable, expectations with your pro forma? That's one story. The second is the qualitative story. It's a story of you, of the sponsor, and where you were, why you've gotten into it, and what you're doing to kind of grow not just your portfolio but also your connections around the industry. So we very much are still an organization that cares about who our sponsors are, who our guarantors are, do they know what they're doing. So for lack of experience, I would say being able to partner with anybody that has that experience really helps. Nothing drives experience like doing something over and over again, whether that's managing it, whether that's partnering with someone as a JV, anything you can do to engross yourself into the industry more is really helpful. But look, there's sometimes where people are buying their first one or second one and they don't have any direct management experience. It may just not be a fit for me, but it will be a fit or could be a fit for other banks, especially smaller community banks that are, looking to lend out dollars, because these are funded dollars typically, which is important for a bank, because that's loans on the book that's outstanding, and a lot of banks really they focus on that themselves. So other than putting together good pro forma with reasonable numbers, there's really just kind of no alternative for experience.
I remember when I got started, Ian and I called 40 banks for our first deal and got 40 no's. At our second deal, we called 15 banks to get 2 yeses, and one of them was a real small bank out of Franklin, North Carolina in the mountains that doesn't exist anymore because it got gobbled up by another bank who has basically told us to stop calling them. So yeah, that was interesting. But it's funny you mentioned earlier about ebbing and flowing of where a bank wants to allocate its lending dollars, and mergers happen, man. And sometimes you get a brand new company with a merger, it's a brand new board of directors and a brand new set of regulations, and can just totally take a 180. And I think what I want to use this as an opportunity to pivot, Steven, is into, all right, someone finds someone like you, which we can talk about. How do you find a Steven Gunzenhauser? But let's say somebody does find you. What are your stresses? Because you like to say that you really have a trifecta of sales to pitch anytime you have a deal brought to you. For the audience, expand upon that.
Sure. I am selling 3 times at the end of the day. The first is I'm selling myself to you, the client, why you should do business with me and with Truist in general. Then you say, okay, let's do a deal. You send me the numbers, I put it together, I bring it to credit. I have to sell credit on the concept of what you're trying to do, purchasing a property, renovating, what have you. And inevitably, always, what I propose is not necessarily what credit accepts. I love and approved as presented. That happens maybe 5% of the time. Credit is going to back the loan proceeds down. They might recommend raising the rate, putting in additional collateral. And I bring back a package in terms that are different than what we originally discussed, which is I want people to understand that this happens all the time. And what I bring back, what I try to do is find the middle ground that works. And the third sell is me going back to the client and trying to sell what I've gotten approved. And I'll say that for most lenders, we are really just trying to get things done at the end of the day. There is no joy for me or anyone to sneak in an extra quarter basis point in fee or in pricing or add $100,000 of cash collateral. I don't care at the end of the day. I mean, I care to an extent of, making sure that Truist is safe, but I'm not doing it for me. I'm doing it because that's what credit wants. And so if I come back at, let's say 20 years on the amortization, you wanted 25, that means I could get 20. And I might be able to go back one time with an ask, but I can't. I really recommend people not trying to beat up your lender going back and forth 5 or 6 times, because what that does is it shows that you have I don't want to say combative client, but someone that is only there to try and, squeeze out the best terms and rate. And the look, when I go back to credit 3 or 4 times, is not necessarily relationship driven. And at a place like Truist, the relationship is still very important for us. So, it's tough sometimes because I try and shield my clients from a lot of the conversations that occur. So if I'm coming back to you, Ryan, and I'm saying, hey, here are the 10 questions. What's the makeup of the structure? Like, give me all the details so I can try and ward off those questions from the very beginning.
Look, I want to reiterate what you said a little earlier, which was you've got to tell a story to credit. And a lot of folks who are new to the space ask me, man, should I put together like a 20-page business plan and a complicated pro forma and things and stuff? And I think that I already see you shaking your head, Steven. Does that help? I think it helps if and only if you can then take that and sell that to credit. So in other words, like, are you going to go and read a 20-page document? Dude, no. Right. But if you, as in the novice or newer person to the space, can give you some good, strong bullet points, or at least what you and I do sometimes is we'll spend an upwards of an hour on the phone together going through the pro forma. So then that way you're like, I already know what credit's going to ask me. I know where they're going to get fussy. Let's spend some time on the phone together, 20 minutes, 30 minutes, an hour, whatever it is. So then I have the ammunition I need to go to war. So putting together a business plan, like we could already say, it's probably not the right answer there.
Well, we don't need, I don't need 20 pages of fluff, right? So there's, we're all basically just doing the sniff test. Does this make sense, right? And we're detecting what's real and what's fluff and whatnot. Yeah, I mean, I was on the credit side for long enough that I know what credit is going to come back and ask for. And so, it's things like when I see a pro forma, if someone's sizing up what they want loan-wise and they're using a rate of 325 or 350 right now, all banks stress their underwriting. And so when I see, let's say they want $1 million and I come back at 750 and they're like, well, I need $1 million. Well, the rates aren't 3.5% anymore, and vacancy is not going to be 0%. We have to include something higher. So, realistic pro forma, if the numbers make sense, there's a growing belief that the person kind of knows what they're doing. And so if the numbers are all over the place, then it kind of starts things off on a little rocky foot where I say, well, if they're not like getting the numbers right, what kind of experience do they have? So and that doesn't necessarily kill a deal. It's just things I have to work through on my side that I try and clean up before I ever send a credit.
So, ladies and gentlemen that are listening in, even more experienced folks, it sounds like the pro forma and the story behind it is more important than giving fluff. Basically, when you put together for a syndication one of those big fancy dancy packets with all the pictures and things and stuff, like, that's a different sale. What big reason why I wanted to bring Steven on the podcast is to address the fact that he is good. You are in part selling him, of course, but he's then got to go around and sell someone that you're never going to see. Right. So it's just so important to have a good rapport and good relationship with a commercial relationship individual banker like Steven, and allow it to take years to build. So you really, like, I pretty much know what Steven's going to ask me before I bring him a deal. And I've already got it done. And I get questions all the time like, oh man, I live in California. I want to buy in Idaho. How do I find a bank? I'm like, like, it really took me a long time to build relationships with people like Steven. And like I mentioned earlier, our second deal ever, Ian and I called 15 banks to get 2 yeses. And what I'll say is we basically Googled banks in Asheville, North Carolina, and called all of them. And the terms we got weren't great, obviously because of experience, but also because, this is a brand new loan, a brand new relationship. And to
Mhm.
me, and Steven, I think you'll agree with this here, a lot of times you just want to get your foot in the door with a good bank because things get better with time. And yes, sometimes it's going to ebb and flow. They're not going to have the terms you want. Sometimes they will. But to me, if I bring a deal to Steven and Steven gets me a term sheet, I know we're closing this deal. I cannot tell you how many times over the years I have gotten a term sheet that have been really, really, really nice on terms. And then after my money goes non-refundable, things change. Things change. I've even had deals ripped from me after I've spent over $30,000 in due diligence. This has happened to me before.
Yeah.
So it's so important having a someone who you've got good rapport with. And you mentioned the experience bit, Steven. It's mutual, man. For me to call up a name like Truist versus a smaller local bank that at any moment could get gobbled up or go under, like Truist ain't going anywhere, man. It just that alone makes it worth a little bit more here or there on the term sheet.
Well, I'll say this, commercial real estate, at least in the Charlotte area, I mean, it's a big community, but it's really not. A lot of people move from bank to bank every 2 to 3 years, which means I know people at 8 other banks here in town. And if someone calls me and I can't do it, I'm going to refer them to one of my old friends or coworkers that's at another bank that may have an appetite. And so I think going back to the relationship, if there's a relationship, if I can't do it, which happens a lot at all banks, if I can't do it, I want to be able to say, instead of just no, good luck, you know what, I can't do it, but let me give you a contact at South State. Let me give you a contact at Pinnacle or something like that. And, introduce, because we all want to, each other. That, to me, that provides value to the client. And even if I can't do it, they say, you know what, Steven couldn't, but man, he got me connected with someone that could. I would also say, going back to, if you're in California and you want to buy something in Idaho, just call a bank up and talk to a banker without a deal on the table and get an idea of how they're structured. So for Truist, for example, I'm in the Metro Atlanta region, like I explained, the Charlotte metro area in the western part of the state. The way we're structured, I bank clients that are physically located in that area. And I can chase deals to other locations, but they have to be based here. So if someone is in Greensboro and has a deal in Charlotte, I have to refer that to a banker in Greensboro. And so just calling bankers up without any agenda, just to ask what their structure is, gives you a better idea going forward, that if you find a property and it fits within the parameters of where you're located and where the property's located, you can call them. And you don't have to kind of suss out whether the bank is even a good fit for you relative. I mean, that part's done. You can just focus on the deal itself.
I love that. You answered another question that I was going to get to eventually, which is clearly it's a networking game. And
Mm-hmm.
clearly whenever you find the Steven at whatever bank that you've called upon and now you've started that relationship, yeah, you want to buy a deal now and you don't have years to develop a relationship out, but you're getting started before you have a deal. So folks listening in, this is why I preach: pick a market or a handful of markets rather than taking a shotgun approach. Oh, I'll buy a good deal anywhere. No, pick a handful of markets, start getting well networked amongst owners in the area, brokers in the area, and debt in the area now, even before you have a deal, because you never know. And one thing I want to address now, Steven, is I've got a pretty good idea your timeline from when I get you a pro forma and address, high level, and roughly when I'm going to get a term sheet. And I have a friend and a mentee of mine who did a great job putting a really difficult deal under contract, but said he would close in 30 days before he had engaged with the bank. Now, the good news is he did a great job buying himself more time on the contract. So he resolved it and got himself a little bit more time. But obviously, we're not closing in 30 days with the bank.
Right.
Talk to me a little bit about a timeline that you want to see And what should folks who are trying to put stuff under contract keep in mind about when they should start engaging you and what expectations they should have?
Sure. So banking in general has become a very immediate kind of business, whereas something might have taken 1 to 2 weeks before. People are expecting immediate responses. I have times where people send me something at 9 a.m. and by 3 they ask, "Where are you with this?" And I just have to sit back and kind of laugh, because the one thing I want to say to so many clients is, look, I appreciate your business, but you are not my only client. And we're all busy, right? So I would say that the biggest thing for me when I get a deal in is having all the information up front. If I have all the information up front, I'm really not having to reach back out with a number of other emails to keep collecting info. So I think that's really important, is having an idea of what you need, right? I mean, a pro forma, a budget, if you're going to do capital capex, 3 years of prior financials if you have it, your personal financial statement, like your tax return, things like that, that show that you're prepared and you have that financial package along with the package for the property that you can just kind of send. How easy would it be if you did that legwork up front and you had an email, someone says, "Hey, here's what I need," boom, you fire it off. And then you maybe have 1 or 2 follow-up emails. So look, banking's kind of a commodity. We're all selling loans at the end of the day, kind of the same thing. We differentiate ourselves on service and speed of getting back a term sheet. So I would say if everything's delivered up front, 1 to 2 weeks on getting a term sheet back. Let's say that's accepted. Then we move on to ordering an appraisal. Now, I want everyone to just realize that most banks, I think all banks now since 2008, they don't run their own appraisal groups. We have an appraisal department, and we put bids out and we get those bids back. We don't know who the appraisers are because we can't do that anymore because of what happened back in 2008. And whatever those bids are, that's what the market's dictating. 2 weeks, it could be 4 weeks, it could be longer. And so that, I think, is the main thing to think about. That's the longest lead time, is an appraisal. So let's say it's 3 weeks, and then probably another 3 to 4 business days for it to get reviewed internally, depending on what each bank is. So really about a month for an appraisal. So setting even 40 to 45 days is going to be tough, because at least at Truist, we use the appraisal for our final underwriting, and that still takes maybe another week when that appraisal gets back. So I would say, at least on my side, 60 days is a better fit. Unless if you want to do 30 days, maybe you get some hard money in the interim to help close it. But really 60 days is the way to go. And so when we get a term sheet, we answer the basic questions. Does this make sense? Yes. And then with the final underwriting, that's where we go in and button everything up. We make sure that the credit is as good as you say. We make sure that the appraisal comes back and confirms the value of the purchase price, right? We make sure that the market is as strong as we made in our assumptions for underwriting. And so things will typically change. I'll say that Truist, we definitely always try to honor our term sheets. We don't flippantly put them out there because they're reviewed by credit on the front end. And so the majority of the time, 90% of the time, those terms are basically the same. It's not exactly the same as what the term sheet says. And so with floating rates, the fixed rate's never really an issue. But I would say, long answer to your question, 60 days from when the term sheet is accepted, with the appraisal being the longest lead time.
Yeah, look, I always, when I have a verbal acceptance to an offer and I'm in contract negotiations, which almost never happen immediate, it's going to take a week, 2, 3, sometimes 4 weeks beyond just someone saying, "Yes, I agree to sell to you at said price," and we're both inked. And in that time, I'm already starting my due diligence. I'm already buttoning up a pro forma. I'm already speaking with Steven. And so that way, as soon as that contract hits, I've already done some due diligence, right? I've already engaged with easy things to engage with, like the local zoning department, to make sure that we're legal conforming or legal non-conforming, that we all agree on the number of lots there are and the setback rules and things and stuff, right? So that way, the really easy due diligence stuff, are we in a floodplain? If so, what does that mean? I'm already doing that before we're even actually under contract, because to your point, the sellers, as soon as they sign a contract, think they've sold the thing. And that's not how it goes, especially mom and pops. You're like,
Right.
well, congrats, you're probably selling this. Not definitely, because remember, I got an inspection period and bad things could happen along the way. So
Hmm.
it's best to engage, from my perspective, it's best to engage as soon as humanly possible. Right. And I will say publicly that, and having done tons of deals with you, Steven, and with BB&T and now Truist, I have to say a bank that honors its term sheet is it's just, it buys, in my mind, you a leg up over the competition. Even if they put a cherry on top and you don't, I'm going with you because I know you guys are going to stick to your word. And I just cannot say enough good things about Truist. So I had to get that in there. They are not paying me to say that.
Oh, well,
It's the honest to
thanks.
God truth. I want to do more deals with you guys because, again, like, from my perspective, I want to get the deal done now because I buy mostly turnaround stuff, and the type of loans that you give us, Steven, are more like you guys want to get paid back within, say, 5 years, right? And hopefully at that point in time, you get permanent debt set up, which you can tee up for me. And, from my perspective, like, if it's an extra 25 basis points, or if it's, it's 23-year AM instead of 25, or there's an earn out in there rather than all money up front. Like, dude, I know I can count on you. So I just
Hmm.
want to really, really reiterate that.
Well, I appreciate that. That's BB&T was historically, the term sheets were not the same as a commitment letter, but pretty darn close. And Truist has maintained that, which has been nice because that's, our clients have come to expect it, quite frankly. So yeah, but it makes the term sheet process a little bit more challenging. Maybe takes a little bit longer, but that due diligence is done up front.
Yep.
And you're right. With you, we've looked at some more turnaround opportunities. And I'll say this, going back to the experience, don't be afraid to try and see if the sellers will do seller financing, because that story changes. Let's say you do seller financing for 6 months, 8 months, and you begin to turn the property around, and now it's more stabilized than when you bought it. Suddenly there's a story. You've owned and operated this property for 8 months. Now you're just looking to get out of the seller financing debt and into more traditional bank debt. That's a heck of a lot easier than someone who's never owned one saying, hey, I want to buy this for the first time. And that might run you more expensive debt for a year, but you're if you can imagine, it's buying you the experience to have an easier conversation with the bank.
Great. Love it, man. Look, just a couple quick things before we wrap up. So we addressed how to find a Steven, and the answer is just start calling even before you have something under contract, because a lot of these relationship bankers all know each other. So start networking before you need it, which is a fantastic answer. We talked about what kind of stresses Steven is under. And again, it's a trifecta sale. They got to sell you, then they got to sell credit, and then they got to turn around and sell you again. So don't give them fluff, and be prepared to back up your pro forma, and not that they're going to come at you with a condescending tone or a nitpicky tone. They're asking you for ammunition. So your Steven equivalent is going to be asking you for ammunition, so then they can go to war on your behalf. And how do you maintain that relationship? Keep bringing them deals, man. Keep bringing them deals, and keep in touch with folks. Steven, are there any other really good ways you've seen clients over the years just maintain the relationship with you?
At least at Truist, we're a relationship-based bank. Opening up deposits, any of the ancillary products and services always helps. That brings you in as a client in a different way. I remember we did, I think we opened up deposit accounts, credit cards for each of the properties, and that is another story. It means you're a fully bank client. You're not just coming just for the loan. You want a relationship with, your deposits and treasury needs in general. So not coming across as not just searching for a loan. A lot of bankers like that because you're bringing in a relationship and just calling to ask questions. I mean, I should be doing it on my own, reaching out proactively to let people know, but like what our appetite is, but just calling, say, hey, I've got a property. What do you think? Can if I send you some numbers, could you, back the napkin, tell me whether you think this would work out? And I'm fine doing that. I mean, I field a lot of those requests saying, hey, I've got a property, I'm looking at it. What do you think? And I'll say, well, I think we could probably get to X, loan amount. And that would give you and other clients an idea of, okay, here's kind of the general ballpark. And maybe you have a couple banks that you do that to, and you get a sense that, let's say, like I said, you want $1 million, it's coming back at 600,000. Oh, Truist is crazy. And then you call 2 other banks and you get similar answers. You say, okay, maybe I'm overpaying for this, or maybe there's something that I'm not seeing as part of this transaction that 3 banks now have told me is coming up. So just things like that, just being in communication.
Another really cool selling point about Truist, by the way, for those listening in, with its relative size is, so Steven and I got our start together on sub $2 million loans and acquisitions and refinances. And in the last 6 months, we've gotten some term sheets on some pretty substantial properties and little portfolios of properties. So the fun thing too is a lot of times getting your foot in the door with sub $2 million properties, which most newer folks listening in will be starting on for the most part. You can have a relationship with a place like Truist and they can prop you up to that next level, not just refer you outside, which is really, really cool. So again, for those listening in, the majority of folks are going to be looking for sub $2 million deals. The answer is you got to go find these banks and you got to find them before you need them, and maintain the relationship, not just by keeping in touch with your Steven, but also having credit cards and ACH. Like I literally have my ACH token right here, by the way. I love your platform, by the way. You like building out this relationship and having multiple buckets you have, it just makes everything so much easier. So Steven, I really want to thank you for taking the time, man. Any more thoughts before we part ways for today on just kind of what's going to happen in the market? Do you see loan volume coming down? Do you see it getting more conservative in its underwriting? Anything that folks should be keeping in mind with this economic uncertainty we're about to face?
Yeah, I mean, I would say underwriting when it comes to stress rates across all banks, we've seen an increase of stress rates by at least a quarter, about 25 basis points so far. Probably expected another 25 or 50 basis points in the next month, which means, let's say we were underwriting to a stress rate of 6.5%. Seemed crazy that last year when rates were 3%. Now, not so much. And so we'll see that go up. What that does is that's going to put stress on the loan amount we can provide. But the market fundamentals are still there. Like I said, Class A multifamily is only going up. Class B and C multifamily, nearly every single property is being bought out from the mom and pops by investors, and they're raising rents. So those, Class B and C, that was $650 a month in rent, they're going up to $1,100, which really leaves mobile home parks as the last affordable bastion of asset class, which is why I think you can still see increasing rents from 200 up to 400, per lot, depending on the park. So there's still value in these parks. It will just be a little bit tighter with underwriting in general. But I still think the occupancy, all that to say is that the occupancy, we're not increasing that, in our underwriting from 5 to 20% because there's still very much a need for this type of asset class. So just a little more conservative on the sizing models.
Yeah, less speculative betting. And I will say, which hopefully everybody agrees with, that some of the best deals are bought during and shortly after recessionary periods. So yeah, it's going to get a little bleak, probably a little more so than it is right now. But on the flip of this, I think some people are going to do incredibly well. So Steven, thanks for taking the time. We'll end off here, man.
Sure.
How do people find you? How do they get in touch with you? What's the best way to get in touch with you?
Best way is either to call me or email me. I can provide that info now, or I didn't know if you want to tag it into the podcast, or
I
what's
will
easiest.
drop it in the show notes. So anybody watching on YouTube, it'll be right there below. And anyone listening into the podcast, that'll also be in the show notes below. I'll drop Steven's contact information. Guns! Thanks for
Had a
joining, dude. This
blast.
has been fun.
Thanks for having me on.
Rock and roll.